Thank you everybody for being on the call today. I'm super excited to get everyone introduced to our partners here at Carolina Natural Resources Group and all that they do for their clients and our clients and the people that we work with. So if you're here, you're interested, or you have an inkling, or uh, something caught your attention about from the email or the ads or whatever about mineral rights, oil, natural gas, and the benefits not only from the tax side but also from a cash flow side, truly passive income cash flow side. And a lot of people are just not aware of it. They're just not, it's been on the map for a long time, literally, right? But it's just one of those things that are just out of the radar screen of a lot of people's purview when it comes to their finances. And we tapped into this ourselves. A few years ago, I've been working with Jim for, gosh, what, 6 years, 6, 7 years, something like that.
Something like that, yeah.
And when I first heard about this, I thought, oil and gas, natural gas, this is for the big multi-gazillionaires. You got to be a Bush or a Rockefeller or a Kennedy or something like that to, take advantage of these things. And it's just not true. If you understand how real estate works, this makes all the sense in the world. So I'm going to go ahead and give it to Jim, and he can kind of spill the beans and go over everything in detail and show you how it works and how they can help you guys out and take it from there. So without further ado, Jim Heiza and Casey.
Thanks, Stefan. So I'll just start with a quick bio. I was a CPA out of college, quickly went into financial planning because I hated the tax work and CPA work. And then 2008 got me looking for alternative investments, if you will, away from Wall Street. And I stumbled across this thing called, oil and gas royalties. And being in Charlotte, North Carolina, I had never heard of it. But I was intrigued and read the prospectus and went out to Texas. It was supposed to be for a couple of weeks, but it was for 6 weeks. Asked a ton of questions, met a bunch of people. Ultimately, came back, sold my practice to Ameriprise, and partnered with some guys in Texas to start oil and gas royalties full time. Initially, we were buying this for hedge funds in New York and major college university endowments and family offices. We decided to step away from providing these to the big players, if you will, and go back to helping mom and pop on Main Street. A couple of years ago, we started our own firm, Carolina Natural Resource Group, and here we are. So we want to hit home on a couple things. You may have never heard of this, and if you've watched the show Landman, you might know a little bit more than you did before. Essentially, this is real estate. It's deeded title real estate. It's not a fund. It's not a partnership. It's not a Wall Street security. And these assets are cash flowing, and they will cash flow for decades, often generations. So it's categorized as a multi-generational asset. We have several people that invest with us that are third, fourth generation. We have people in the industry that we know that are fifth and sixth generation. And Casey will go through her bio and just some basic understandings of what these are.
Yeah. Sorry, my slides are advancing a little slow. I'm on the slow here on the uptake, but I'm so grateful to be here and that you are all joining us tonight. As Jim mentioned, we loved the show, the Paramount show Landman. And if you saw it, you know that before the deals are made, right? Before any wells were drilled, it all starts with the mineral rights. The very first scene in the very first episode of the show, Tommy Norris is tied to a chair and he is surrounded by angry cartel members. But if you'll remember, this hostage scene quickly turns into a master class on mineral rights. So Tommy explains how his company legally owns the mineral rights beneath the ground. So even if the land above it is cartel territory, he talks about leases, subsurface ownership, and how the real power in Texas doesn't come from guns. It comes from contracts and the ownership of mineral rights. So how does all this work? We're just going to start out by talking about real estate. So, check out this beautiful cabin on several acres. It's a great place for family to come visit on the weekends. But when the owners of this beautiful property purchased their cabin, they only purchased what you can see on the surface. What's interesting about this property is that there's a lot more that meets the eye. You see, the owners of this cabin didn't purchase the rights to the acreage below the ground. These are called mineral rights. And in most countries, the government owns the mineral rights, but in the United States, individuals can privately own the mineral rights underlying the surface real estate, which goes all the way to the Earth's core, even if you don't own the property on the surface. Mineral rights are often passed down through families for many generations. And if you own mineral rights in the United States, you're part of a very fortunate and very small group of people, an estimated 12 to 15 million individuals. So you might be asking yourself, like, why would anyone want to own the rights below the surface? Well, they're a really big deal because when you're a mineral rights owner and your minerals contain resources like oil and natural gas, you have the opportunity to make decades of passive monthly income and build real generational wealth. So, how valuable are mineral rights? When an oil or gas operator, like Chevron or Exxon, for example, drill an oil or gas well, they lease the mineral rights from the mineral right owners in exchange for an upfront payment and an ongoing royalty on the production of the wells. So if you own the mineral rights in this picture and Chevron drills an oil well, you will receive a monthly royalty check from Chevron for a percentage of the revenue from that well as long as it is producing, which is often for decades. At Carolina Natural Resource Group, we buy mineral rights within the country's most prolific oil and natural gas plays, and we help other people invest right alongside us. Okay, so at this point, you might be asking yourself, like, why does anyone sell their mineral rights in the first place? And like, why isn't everyone doing this? Those are good questions, and we can dive into those in the Q&A at the end. But for now, I want to share with you two ways that you can start investing in what we like to call underground real estate. So, the easiest way to benefit from an oil and gas investment within just a few short months is to purchase mineral rights with producing wells on the acreage. This is the lowest risk investment because we can review the revenue produced by the well by analyzing months of check stubs. And we can verify the life and productivity of the well by using highly specialized software. So, with all those resources, we can confidently estimate our rate of return on these investments, which can often be in the mid teens. These investments can provide decades of passive income. And if an operator decides to drill new wells on your acreage, you will receive income from those wells too, significantly increasing your rate of return. Now, another way to benefit from oil and gas investments is by purchasing mineral rights before wells are drilled. And in the industry, it's called getting ahead of the bit. In this kind of investment, the potential rate of return dramatically increases, but you do incur a little more risk, which we mitigate by purchasing mineral rights in oil and gas rich areas where major operators have demonstrated a high interest and intent to drill. Like they have leased the mineral rights, they filed permits, and have a history of successful drilling activity in that area. And we know that the operator uses the most advanced drilling technology. So the rates of return are so high with this kind of investment because when an oil or natural gas well is initially drilled, the pressure is so high that the amount of oil or gas coming out of that well is enormous. And since we make money on the production of the well, we make a significant amount when these new wells first become active. And that's why we think the rewards far outweigh the risks of these kinds of investments. And in a few minutes, Jim is going to show us some real world examples of how this works. We can make all of our money back in a very short time when investing ahead of the bit. And then when the pressure and production kind of level off, we make a great rate of return for decades.
Try to remember that chart. Go ahead, Casey.
Yeah, yeah. So most people who invest with us like to diversify with both options. They go in with some already producing PDP and then they diversify with some upside with the ahead of the bit. Jim is now going to wade us into some deeper waters and unpack the real value of each option and show you some real world examples and assets.
Yeah. Thanks, Casey. So bear with me. We're going to get into the weeds a little bit, but it's more graphical and I'll keep it simple and we can get into the weeds as far as anybody wants offline. So when you think about real estate above the ground, it's virtually the same below the ground. It goes through a process of development. Raw land is this the same as mineral rights below the ground being unleased. An oil and gas company has not come there to lease them. Maybe there's oil and gas, maybe there's not. So it's like raw land. Once it gets leased from an operator, Exxon or Chevron, then you know you've got something of maybe of a little more value. After it gets leased, then they're going to file what's called pre-permits. Those are permits with departments of the state, such as the Department of Conservation, the Water Board, etc. And that you know they're serious because they've done a lot of homework, put a lot of science behind it, engineers, geophysicists, etc., in doing that work. And that pre-permit will tell you how many wells they intend to drill on that acreage. And then the fourth phase is the actual official permit from the Department of Natural Resources. And it's important to note the difference between the two. They're both what Casey called ahead of the bit, ahead of the drill bit. No wells have been drilled yet, but essentially there's very little risk between the two, permits and pre-permits. However, there's a big difference in price. Acquisition price permit is double the acquisition price of the pre-permit. So our rates of return can dramatically increase by starting at the pre-permit for the ahead of the bid assets. And then once the permits are filed and they're ready to drill, the operators will drill these wells. And then there's a second phase where they have to bring in a different crew and different equipment to complete the wells and turn them on. That's when you have what we call PDP, which stands for proved engineering wise. It's proved, it's developed because the
Why?
wells are drilled, and it's
There's a
producing.
seminar going on right now.
Can we mute somebody?
Yeah, I muted him. Sorry about that, Jim.
Okay, no worries. All right, so this the last and final phase, as Casey mentioned earlier, is the least risky. The wells are already producing. We can see the current owners' check stubs, their monthly royalty checks, and we can easily evaluate the economics. So let's get into some real world assets. The first being, wells that already exist. What you're looking at, Stefan's all about taxes, and I love that he kind of geeks out on taxes, and we geek out on this stuff. There's a tax benefit to the mineral rights as well. This income, as Casey mentioned, often into mid to high teens, you're only going to pay taxes on 85% at the federal level. There's a 15% depletion allowance into perpetuity. And since the wells, like I mentioned earlier, since the wells are already producing, the risk is really just the commodity price. Because as you'll see in a minute, when we show you an actual check stub, a royalty check is nothing more than how much oil and gas came out of the wells, what was the oil or natural gas price, and your ownership percentage. So the risk really, we know that the production is going to go down a little every year after that big initial drop. And so the risk is really the commodity price. If you're earning 15% and oil's at 70 and oil goes to 35, you're now earning 7.5%. That's your real risk. All right, Casey, let's get into the next one. We always put out a little summary of when we have an asset that we're ready to share with investors. We acquire them with our money, and then we will keep 10 to 20% usually, and then sell down the rest to investors. And we'll put this little summary out with a Google Drive that will have all of our homework in it for you to review. So back in April, we acquired an asset from two sellers, one in Ohio and one in New Mexico. So we had six counties in Ohio and one in New Mexico. There were three different operators. There were 96 wells. The wells were on average 3 to 4 years old. There were a couple that were newer and a couple that were older, but the majority of them were 3 to 4 years old. And it was about 60% oil, 40% natural gas. And NGLs stands for natural gas liquids, which would be your propanes and butanes and ethanes, etc. The initial yield, based on the check stubs from the seller, was 17%. Now, we knew that was going to jump for two reasons. One, the nat gas price on the check stubs was $2.20. And when we acquired it in early April, it was $3.40. So we knew we were going to get a bump in yield from that. Additionally, they had drilled four new wells, but had not turned any of them on yet. Two of them have now been turned on, and the asset is currently yielding 22%. These maps is what you'll see. The only thing I want you to pay attention to on these maps is how big the plays are. That's the one on the right is New Mexico and Texas. That's the Permian. The one on the left is the Appalachian Basin, which is West Virginia, Pennsylvania, and Ohio. And then the little legend is all of the different depths. So Casey mentioned that the mineral rights go to the core of the earth. And she also mentioned that when they drill a new well, you don't put up any money, but you get paid a royalty. And that's very important. You know, the wells on this asset we're only in two of the zones or depths in Appalachia and three of the depths in New Mexico. And that's important because when they drill the additional depths at some point in the future, we don't put up any money and we get paid. And we start at that very high graphic that I asked you to remember. The production starts really high, so our yield jumps dramatically. So let's look at what a check stub looks like. This is one of the check stubs that we acquired. And if you look right smack in the middle, you can see that the gas price was $2.09 when we acquired it. So that's how we knew the 17% was going to go to at least 19 or 20 without doing anything. And the next few pages are just the remainder of the check stubs from the sellers. And this is all in our Google Drive when we make this available to investors, so you can double check A, our math, and B, that everything is accurate. And that $13,834, that was for the January month. I think the most recent month was almost 16,000. So when you annualize that, that's where the yields jump from 17 to 22%.
Real quick, Jim, before
Yes,
you go,
sir.
there's some people that have some questions, are really good questions. I think they're kind of answered, but if you could go over it again. John asks, what counts as mineral? Is it everything below the grass, or is it only specific elements?
It is everything, but some of the deeds will carve out oil and gas and sometimes coal. Other minerals such as lithium or helium are different types of mineral deeds, so it'll all be specified in the deed.
Okay, awesome. And then Christian's asking, do investors buy into a fund or into individual projects?
Nope, this is deeded title real estate. We don't do anything with funds. We don't keep our hand in the cookie jar. You know, we acquire it for a price and we sell it for a little bit higher price, and that yield that we just showed on the screen is net.
Yeah. And towards the end, once we do Q&A, just so you know, guys, for those of you guys who don't know me, I'm Stephen Bellholm, Prudent Wealth Strategies. We do tax strategies. All you guys are probably in my email list. You met me maybe at an event or whatnot. Anyways, I'll be talking more about the tax side, specifically with Dynasty Trust and how this works. Again, we invest in this ourselves, and it's just been a wonderful opportunity to take advantage of. So,
Okay. So another asset that we just literally made available last week, go ahead, Casey, is in the Permian, which is the Permian Basin is the premier oil reservoir in the country and one of the premier in the world. And again, wanting you to pay attention to the potential upside. So this asset in Martin County, Texas, has 20 wells that are almost 4 years old, 70% oil, again, 30% natural gas and natural gas liquids. The initial yield 16% based on the seller's check stub, most recent check. The map you're looking at here, you see a bunch of colored lines. Every one of these lines is a horizontal well. And the different colors show you in the legend, it's based on what depth has been drilled. Now, the yellow circle in the middle is our acreage where we acquired. Notice it looks like it's full, like maybe they can fill another well or two, that little space on the eastern side, but that's not true. It's deceiving. Hang on, Casey, go back one, please. This is a 5 mile radius. So notice in 5 miles, if you count in the legend, the number of depths that have been drilled, it's 15. Okay. All right, Casey, go ahead and move forward, please. Zooming in on our acreage, notice the legend. They've only drilled 5 depths. So although it looks like we can maybe squeeze in a well or two on the eastern side, it's actually more than that. There is significant upside because each depth, the 10 that have not been developed, can hold 3 to 6 new wells, which is an additional 30 to 60 wells. Now, where this gets super exciting, and remember that looks like a roller coaster hill, the first chart we looked at. If we take the existing 20 wells on this property, and I look at the production currently, they're averaging about 3,000 barrels a month. Their initial production at the very beginning, when the pressure was high, it was averaging 38,000 barrels a month. You take that average and if they drilled another, for every 1 to 2 wells that they drill on that average, you're looking at increasing the yield from 16 by 40 to 50% more. So 22 to 25. And if they drilled another 20% or 20 wells, the yield would just go through the roof. So the upside here is fantastic. And as I said, we put this out just last week. We've got a couple of 100,000 left. It's first come, first serve. That's how we work with all our investors. Shoot us an email, shoot us a text. Hey, I want to do in 50, I want to do 100, and then that locks you in, and we'll work on contracts in a week or so.
So real quick, Jim, John's asking another question. Are
Mhm.
easements involved in regards to extraction? What if minerals are directly beneath a random family's home?
What was the first part of the question?
Are easements involved in regards to the extraction?
No, there are rules in every state that you cannot put a well within so much of a distance of a house, and it doesn't matter where below the ground they are. In almost every state, well, the rules work basically the same. They're just a little nuances. Essentially, if you're in one little corner of one of these squares and they drill a well on the other side of the square, it doesn't matter. You get pooled together and it's just pro rata for everybody in that square. And by the way, those squares are 1 square mile. They're called sections. So it doesn't matter if the wells are on the west side and you're on the east side of a section, you're pooled together and it's just arithmetic to figure out how much you own. All right, Casey. So let's talk about ahead of the bid. Casey mentioned that the returns can dramatically increase, but so does the risk because the wells aren't drilled yet. Um, we acquired this several months ago. It's natural gas. It's in Louisiana, and you don't have check stubs or royalty checks to look at and analyze. So how do you look at it and know what kind of money you can make? It's similar to real estate. When you go to a realtor to buy a home, what's the first thing they do? The realtor pulls comps of similar homes in that area, right? It's the same thing here. So we know where our acreage is. We go to wells that have been drilled right around our acreage and we pull the comps. How much did they produce? What was the initial production? And when you do that and you just do the math, you can see that the estimated rates of return at $4, $5, and $6 nat gas are tremendous. It's north of 100% in the first 12 months of these wells being drilled because this one has 12 pre-permitted wells, and we'll show you what that looks like in a minute. They're not permitted, they're pre-permitted. And that estimated EUR, that stands for estimated ultimate recovery on the initial well. They can go back in and repressurize, but on the initial well, you're looking at 4 to 5 times your money, which is important. And you're going to get, remember that slope, you're going to get 60 to 70% of that in the first 2 years. Okay, Casey.
Mhm.
Here's a map of where we acquired. The star is our acreage. You can see the lines again are just wells all around us from different operators. And then the next slide is this is a plat, which is on the actual pre-permit filed with the state Department of Conservation. We won't get into the details of this. We always put this in our homework, but there's 12 wells, 6 in the Bossier depth and 6 in the Haynesville depth. Okay. Okay, so we mentioned the risk on pre-permits and permits without wells being drilled is the timing. When are they going to drill? So we just did some simple compound annual growth rates. We know roughly at $4 or $5 and $6 what we're going to earn in the first year and then the second year, but factoring in holding it for 2 years without them drilling or 3 or 4 years, it changes the rates of return. And you can see here, we're still ranging from the low 20s or in $6 case, the high 20s to the up mid 30s or even in the 40s annualized, even though we don't get anything year 1, year 2, then the wells are turned on, drilled and turned on, and we get all that cash flow.
Yeah, and Jim, I just want to make sure that they understand the $4, $5, $6 is the commodity price, the
That's correct.
projected nat gas price, which right now is where are we at?
340.
340.
340.
Okay.
Yep. And we'll talk about that in just a minute.
Yep.
Good point, Casey. Okay, so what are the benefits? First, it's cash flowing underground deeded title real estate with very high returns. Think mid to high teens to start. And if you're used to commercial real estate, it's similar to a triple net lease. Okay. Tax efficient. There's a 15% depletion allowance. So you're only going to pay taxes federally on 85% of the 1099 income. It does qualify for 1031 exchanges because it's real property, deeded title real property. Again, because it's deeded title real property, you have flexible investment options, self-directed IRAs, self-directed 401ks, trust, LLCs, joint, single, however you want to title it, doesn't matter. And it is true passive income. In the industry, we call it mailbox money because before ACH and wires and all that kind of thing, it literally was you go to the mailbox every month and collect a check. That's all you had to do. It's obviously independent. It's not tied to Wall Street. It's not tied to traditional real estate market cycles. It's in a class by itself.
And can I just say real quick, Jim, because for us, this has been a game changer because I've been a landlord. I've been in real estate. I've dealt with tenants, and it just sucks. So being able to have that mailbox money and not have to deal with the hassle and the headaches and the issues with people. And some people love real estate more than others. Me, I got into it to make money, but it was just too much of a headache. So this is just a great opportunity for people that want to kind of be in real estate, but not deal with the headaches of dealing with tenants. So
Yeah, and I'll bring up one good real world example. Also, Stefan, along those lines, before we get into the natural gas outlook, we have 2 sisters that are third generation that invest with us, and they owned a property in West Texas that had not paid them a royalty in about 10 years. So, in layman's terms, some people might think the wells went dry, right? Because it hasn't paid a royalty. Well, we were just in Houston a couple of months ago and with one of the sisters and had lunch, and she whipped out this check and she didn't know what it was. And she showed it to me and I looked at it and then I got on my computer and I looked up. They drilled 3 new wells on that acreage that had not produced any royalties for 10 years. That check was $300,000. That was 1 month royalty check. So your acreage doesn't go to zero. It doesn't, it's land. There's always value there. We only have the technology to pull out 40 to 50% of the oil and gas in place currently. We don't know how to get the rest out yet. So it doesn't go to zero. Now, there's an asymmetric opportunity here as well. Putting my Wall Street and CPA hat back on, when nat gas prices crashed a little over a year ago, and we owned a bunch of this stuff, I went researching. And Casey will tell you, I gave her 1,500 pages of research with highlights, and we created this nat gas outlook. Essentially, what it says, And we've been to conferences, I think 3 conferences now. Every speaker has proven this, saying the same thing. By 2030, the demand for natural gas is going to increase 40% in the United States, and it's coming from multiple sources. Liquefied natural gas exports are going to double. That's 15%. Electricity demand is going to double. There's another 15%. You've got natural gas power plants being built all over the place and replacing some coal-fired power plants. That's another 10%. So demand is going up. And these are projects that are not just being talked about, they're under construction. It's coming. Now, the supply is another issue. As we saw on that graphic that looked like a roller coaster, every well depletes, right? Well, if we don't drill another natural gas well starting today, by 2030, the existing supply is going to drop 30%. So we have to come up with 70% of our current supply in 5 years. There's not enough drilling rigs to do that. Prices will adjust upwards. And as we heard on multiple panel conferences, in the conferences, a tsunami of demand is heading right for us. It's not a what if, it's not a maybe, it's not this policy, that policy. These are projects under construction. Okay. You've heard a lot. You've heard that, the underground real estate cash flowing is great, mid to high teens. That's bucket number one. The risk is very minimal. It's commodity price. And again, you don't get a statement showing you're down 50%. Your yield, your monthly income just goes down when the price of oil or natural gas goes down. But it can also go up. If they drill a new well, it could go up. If they drill 10 new wells, it goes up a whole lot. So that's one option. And we would recommend for initial investors to at least start there with something, because you're going to start to get a monthly check after the deeds are recorded and the transfer of ownership is processed at the operators like Chevron, which, by the way, will take 90 days. They're going to quote you 90 days because they're so understaffed. So in 4 months, you're going to get a check and it'll be backdated all the way to your effective date. But then you start getting monthly checks pretty quickly. And then if you want to take a little more risk for a potential higher return, you've got to head of the bit. And so a sample like starting phase, if you had 150,000 you wanted to allocate to this, maybe you put 100 into producing and 50,000 for growth. Think of like income and growth. The income for sure, you can also get growth on the income, but income on bucket number one and growth in bucket number two. Because the risk there is you don't know when they're going to drill. And we have a little bit of that DeSoto one left. We acquired a ton of it. We kept a bunch of it ourselves. If you wanted to dip your toe into that, we'd let some of that go too. This is our contact page. Feel free to email us, go to our website, call us, text us, set up a Zoom call privately, however you want to do it. We're happy to speak offline. And again, as I mentioned, we provide all of our homework. There is a Google Drive for each one of these assets that we can share with you, and you can go and look at all of the documents yourself.
Mhm. And I just want to reiterate too, Jim, you had mentioned we've got about 200, is it 200 left?
Yeah, the one in West Texas that we just put out, made available last week, we've got about 200 left.
And that's the
Again,
one
it's
that's
first come, first
producing.
serve. Yep, it's
Yeah.
producing 16%. 10 depths have not been drilled, so a lot of upside in the future. Again, shoot us an email, shoot us a text. The minimum's 50K, and we'll just get the contracts drawn up by the end of the week.
And real quick, for those of you guys that didn't, pretty much everyone that did register should have received that. I sent an email out. So if you didn't, you can email me or email Jim and get that. But we sent that Outlook to people.
With the Google Drive?
Yeah,
Yeah.
yeah, they should have gotten that. So, all right, I have a question here from Christian. I guess he meant to say, do the reserves bleed into each other under connected properties like they might with water? I guess he's saying like, hey, if you're on one plat, or matter of fact, I mean, you guys can unmute yourself if you have, if you want to just ask your questions now, because we're
That's a
pretty.
good question. It can laterally, but not depth-wise. Typically, there's a pretty good spacing on the depth, but the operators will space the wells laterally on purpose based on their engineers and geophysicists so that those wells do not interfere with each other. We call it talking to each other, so that they do not interfere with each other. And what you'll see is when they go into a reservoir kind of early, whether it's the Haynesville, the Permian, or up in the DJ up in Colorado, they'll start with a wider spacing. Okay. And then as they get to know the geology even better, they'll come back in and put wells in between where they can, as long as they're not interfering with the existing wells. We call that infill drilling. So not only is it possible to get new wells in the same depths that have been developed, obviously we can get new wells in the undeveloped depths, but you can actually get new wells in the same depths also as they reduce that spacing.
Awesome. So I want to go back to what Casey was talking about in the beginning. And if no one here has a question, I can just throw this out because this is a question that I had is number one, why isn't everybody doing this? Number
Mhm.
two, why would someone, if they have a gold mine, under their property, why would they sell it to you? Sell it to anybody, right?
Those are great questions. Essentially, it's been hoarded by families. Those two sisters I mentioned, it was pounded into their head by their grandfather, never, ever, ever sell. You go talk to a rancher in Texas who bought a ranch without the mineral rights, they'll tell you, I'll never do that again. It has been hoarded by families, family offices, university endowments, life insurance companies, but it's a multi-billion dollar industry. And as Casey mentioned, there's 12 to 15 million different mineral owners, because as it gets inherited down the generations, it gets divided up. And typically what we see for sellers, it's one of two things 99% of the time. One, I inherited this from my grandmother or my grandfather, and I want the cash up front. I don't want this monthly check. It might be a couple of $100. I don't want it. That's number one if it's an individual. Number two, there's a lot of industry players in this business, and they like to take more risk. Maybe it's a fund or a family office that bought before the acreage was even leased. Remember that little chart we had on the process where it starts with unleased, then goes leased, then pre-permits, then permits. If they start unleased, of course, the cost to acquire that's going to be a lot cheaper. And then they wait because it's a family office. They'll wait a decade for those wells to be drilled. And once they're drilled, they're out. They want to go take cash out and go do it again. We see that all the time. In fact, that West Texas Martin County one where we got a couple 100,000 left, that's exactly what that is. Same with the Ohio piece on the other one.
Anyone else? Any other questions? Come on, guys, don't be shy. Now's the time to get your questions answered.
It's real.
This is real stuff. Well, I'll just interject real quick and just to kind of talk about the tax side, 'cause I kind of promised this with Dynasty Trust, is, you know, I for a long time, I didn't think of oil and gas as a real estate, right? It's just some nebulous investment, mineral rights, whatever that you got to find, some person who's dealing with it, right? Um,
Hmm.
then I finally understood, and Jim drilled into my brain. He can tell you how much he drilled into my brain about this asset, that it is just real
Hmm.
estate. So from the tax standpoint, again, Jim talked about, the depletion benefits that you get, the fact that it can be 1031 exchange. So if you have rental properties, this is a great opportunity to 1031 into something that really makes sense because for a lot of people, especially people that have, commercial properties, multifamily units, the cap rates just suck out there. There's nothing for them to 1031 to. And so they're just 1031 into a property just to save taxes, but it's
Hmm.
a crappy property. So this is a great opportunity to do that and get the cash flowing. Again, 401ks, IRAs, if they're self-directed. But Dynasty Trust is a great opportunity for a lot of people that most people have never heard of because essentially you're able to, own these deeded real estate properties and mineral rights inside of the trust, have all the income, all the monthly paychecks, mailbox money, as Jim said, come into your trust and basically defer the taxes for generations. And these are things that a lot of the wealthy families, like the Bushes and the Rockefellers, have been using for generations because, again, as Jim said, this is about creating generational income, right? Those sisters, man, I wish I was their great grandfather, whoever it was. I mean, they're a smart person. They're smart people. They knew the value of having that. And, I didn't understand about this. I wish I would have, done this or learned about this, a lot sooner. But the whole point is, with the Dynasty Trust, it allows you to basically, have the same tax advantages of, a 401k or an IRA because you're deferring the tax forever, but you get to utilize the income inside the trust. You can buy more, investments, buy more oil and gas, opportunities. You can use it to, pay mortgages and different expenses on properties that you have. It's just a very efficient tax advantage way to do things. So that's just another opportunity for any of you guys that are interested or have questions. Is hey, you can do this inside of a trust, and it makes a whole lot of sense. Plus, you have the asset protection, which a lot of people don't get inside of a 1031 exchange because it's in your personal name. So utilizing trust, that's why wealthy people do these things because it keeps their name out of things. And with the Dynasty Trust, they don't own it; it's owned by the trust. So if anyone tries to sue you or lawsuit liabilities, it's not an issue. So, um, Fritz asking, what is the property tax rate for this kind of real estate?
Yeah, it's a good question. In most of the royalty checks, the ad valorem or property taxes is severance taxes is deducted. And so when you see that net 17% or 16%, that's net of those taxes. It comes out of your check. There's a few counties that don't do that. And you have to actually, they'll send you a bill and it's super confusing, but it's really small. Like Dimmitt County, Texas will do that. They'll send you a bill for the taxes and it's not even a rounding error. It's less than 1%. Any other questions?
Going once, going twice.
We must have explained it pretty good.
Awesome. All right. Well, that's pretty much it. Thank you guys for hopping on the call. Again, if you have any questions, you can reach out to Jim offline. You should have his contact information. For those of you guys that want a copy of the recording, you will be getting access to our T program. It takes about a day for this to render and get edited. So I would give it probably by Thursday. But this will be on our T program on our portal where all of our recordings are. So you guys will get access to that, get all that emailed to you. So that's pretty much it. Thanks, Jim, for taking the time out and going over everything so beautifully and answering questions. And hopefully you guys got a lot out of it and can really understand how to take advantage of this type of opportunity now and to help yourself, help your family, and just be a lot more efficient when it comes to your wealth. So
Yeah,
thank
thank
you.
you, Stefan, for having
Good.
us.
Yeah, thank you so much, everybody, for
Mhm.
taking time out of your night. So thanks,
All
Stefan.
right.
Yeah.
Y'all guys have a good one.
All right,
Bye.
you
Talk
too.
soon.
Bye.